When you think about fintech startups, there's the standard playbook,
Correct.
right?
The growth first, physics later model.
Exactly. Burn cash, get big, and worry about profit.
Yeah.
Well, maybe never. But today we're looking at a company that seems to be defying that gravity.
StashAway.
Right. We're doing a deep dive based on this new research report from PrivatiIQ, and it suggests they've hit a milestone that most robo-advisors are still just dreaming of.
Profitability.
Yeah.
Real, actual profitability in their core market.
Which is so rare. So our mission today is to unpack how they did it and what their strategy really signals for the rest of the wealth management world.
It's a fascinating case study in that pivot from a cash-burning startup to a sustainable company.
Okay, so let's jump into the numbers. The headline from this PrivatiIQ report is that StashAway's Singapore operations are now EBITDA positive.
Right. For FY24, we're talking $1.4 million in the green.
And that's the inflection point. But the report suggests the raw profit isn't even the most interesting part. It's this idea of operating leverage.
That's the real story here.
I see that term thrown around. What does it actually mean in this context?
It basically means their revenue grew much, much faster than their costs. So revenue jumped 36% to nearly as $15 million.
Okay.
But their marketing spend, it was almost flat.
Wait, that feels counterintuitive. To get that kind of growth, you'd think they'd have to just pour money into ads.
You would. And in the early days, you do. But this shows their tech platform has matured. They can scale their assets and revenue without needing to hire a ton of new people or, just keep burning more cash on ads.
So they've decoupled their growth from their headcount, unlike a traditional bank where more clients means hiring more bankers.
Exactly. And that financial freedom lets them play a totally different game. It brings us to their new strategy. They're not just for retail investors with simple ETF portfolios anymore.
You mean StashAway Reserve?
Yes, they've identified this missing middle in the market, people with a net worth between, say, $1 and $10 million.
The high net worth crowd.
A bit, yeah. They're sort of too wealthy for a basic app, but maybe not quite at the level for the white glove service from a huge private bank. StashAway is trying to build a moat to capture them.
And they're doing that by offering private equity and private credit, right? I see they've partnered with giants like Hamilton Lane and KKR.
They have, and that's the moat, because that's not easy to do. But the real aha moment is the democratization of it all.
How so?
Well, normally, to get into a KKR fund, you need that velvet rope ticket. I mean, we're talking a minimum investment of maybe US $250,000.
Right.
StashAway has dropped that barrier to US $50,000. In some cases, even US $20,000.
Wow, that's a massive difference. You're taking institutional-grade assets that were totally locked away and putting them on a dashboard.
Precisely. It moves them out of that commodity game of just selling ETFs and into, real wealth management.
But the report isn't a total glowing review.
Right.
PrivatiIQ uses these proprietary metrics, their smart score.
And it's a very nuanced picture. They give StashAway a 3.7 out of 5 overall.
Okay, so what's working and what isn't?
Well, on one hand, their product affinity score is really high, a 4.2. The data shows people who use the app genuinely love it. The interface, the content, it's all very sticky.
But there's a but.
The but is in their authority and visitation scores. Both are down around 2.8.
That's lower than I would have thought. What's dragging it down?
Organic reach. It seems it's just getting harder to find new users through search. I mean, they're in a tough fight against the big banks like DBS with its Digiportfolio. Those guys have huge built-in customer bases they can just market to.
That actually lines up with something the CEO said in the report. He said his biggest competitor isn't even another robo-advisor.
That part really stood out to me.
Yeah.
He said their biggest rival is just cash in the bank.
Inertia.
Exactly. It's not a tech versus tech battle. It's getting people to move their money out of a low-yield savings account in the first place. That's the real fight.
So if we pull this all together, StashAway has proven the model works in Singapore. And the plan is now to replicate that in newer markets like the UAE, Thailand.
They've got the blueprint. Now it's a matter of execution, time and scale.
It does leave me with this bigger question, though. If these digital platforms can successfully democratize exclusive private assets and do it profitably, what happens to the prestige of the traditional private bank?
That's the billion-dollar question, isn't it? Once that velvet rope is gone, and the access is pretty much the same, can the big banks really justify those huge fees? That gap is definitely closing.
Something to think about. That's it for our deep dive into the PrivatiIQ report. Thanks for listening.